Statutory Surplus, Computation, Pricing, and Valuation, prepared by S. Feldblum, 5th edition, June 2003. Statutory Surplus, Computation, Pricing, and Valuation. The development of financial pricing models for insurance products and the advent of risk-based capital requirements have led to an increasing focus on capital. This study note explains the differences between statutory surplus and invested capital and the implications for actuarial pricing and valuations. When insurance products were priced to a 5% underwriting profit margin, some states mandated that investment income be considered, often by simple investment income offset procedures that reduced the underwriting profit margin for the investment income earned on policyholder supplied funds. These procedures did not consider capital or surplus. Insurers are now using return on capital models for pricing and performance measurement. The pricing models vary in their definitions of capital, whether statutory surplus, GAAP equity, economic surplus, or invested capital. Similarly, actuarial valuations may use GAAP earnings, statutory earnings, or cash flows. The valuation results differ sharply, and proper valuation relies on an accurate assessment of the capital supporting insurance operations. The idiosyncrasies of statutory accounting complicate the relation between statutory surplus and invested capital. For example, the statutory income statement shows net income earned during the current year. One might suppose that last year's surplus plus this year's net income should equal this year's surplus, but there are half a dozen other adjustments, such as the change in non-admitted assets, or the change in the provision for reinsurance, which are direct charges or credits to surplus. In contrast, the surplus figure on the balance sheet is total assets minus total liabilities, with no adjustment for direct charges or credits to surplus. The sign on the income statement adjustments is also confusing, since an increase in non-admitted assets causes a decrease in the policyholder's surplus. Some readers wonder, why should an increase in assets, of whatever sort, lead to a decrease in the worth of the company? This study note traces the computation of statutory surplus, along with the difference from GAAP equity, contrasts statutory surplus and GAAP equity with invested capital, and adds the capital in the policyholder reserves with the capital required by statutory regulations to determine the capital supporting the insurance policy. Balance sheets and income statements. Surplus has two definitions. The balance sheet definition says surplus equals assets minus liabilities. The income statement definition says surplus equals last year's surplus plus current year's income. If all balance sheet transactions also flowed through the income statement, and if all income statement transactions had corresponding effects on statutory assets and liabilities, the two definitions of surplus would be equivalent, and no adjustments would be needed. Illustration. Suppose an insurer begins the year with $2,000 in surplus and $2,000 in cash, and it writes a policy for a $1,000 premium on January 1. An insurer normally holds marketable securities, not cash. We use cash in this illustration to avoid the accounting entries for investment income. The insurer incurs expenses of $250 and losses of $600 during the year. Statutory accounting is on an accrual basis, not a cash basis. It makes no difference whether the premium has been collected or is still owed to the company, so long as the receivable is admitted, and no difference whether the losses are paid or held as reserves. Let us suppose the premium is collected on January 1. Expenses are paid during the year. 200 of losses are paid by December 31, and 400 of losses remain in reserves. During the year, the cash account increases by the $1,000 premium and decreases by the $250 of expenses and the $200 of paid losses, for a net increase of $550. At the end of the year, the cash account has the original $2,000 plus the year's increase of $550, for a total of $2,550. Liabilities, which were zero at the beginning of the year, increase by the 400 case reserves. Surplus at year end is $2,150, or the $2,550 of assets minus the $400 of liabilities. From an income statement perspective, premium earned is a revenue, and losses incurred and underwriting expenses are expenditures. Net income equals revenues minus expenditures, which is 1,000 minus 600 minus 250, which equals 150, is the addition to surplus during the year. At the year end, income statement surplus has increased by 150, revenue minus expenditures. Balance sheet surplus of 2150 equals total assets, 2550, minus total liabilities, 400. In the accounting presentation above, ledger transactions are entered onto an accounting ledger. Year-end adjustments are non-ledger items. The balance sheet and income statement definitions of surplus are not the same if some balance sheet transactions do not flow through the income statement. Non-admitted assets and statutory liabilities affect the balance sheet. The income statement does not differentiate between admitted and non-admitted assets. It is not affected by statutory liabilities. Non-admitted assets. If 100 of premium remains uncollected and more than 90 days past due on December 31, it is not admitted. The income statement entries remain earned premium, 1,000, incurred losses, 600, and expenses, 250, for a net income of 150. The income statement surplus before any adjustments would be last year's surplus of 2,000, plus the net income of 150. The balance sheet recognizes only the admitted portion of assets. The premium collected of 900 increases cash by 900. The remaining 100 of earned premium appears as premiums and agents' balances in course of collection, page 2, line 10.1. Since it is overdue, it appears in column 2, assets not admitted, and it does not enter into balance sheet surplus. The balance sheet calculation of policyholder surplus is as follows. At the beginning of the year, cash on hand or on deposit is 2,000. We add to the cash account the collected premium of 900 and subtract expenses paid of 250 and losses paid of 200 to get cash on hand or on deposit of 2450 at the end of the year. The 100 of uncollected premium more than 90 days past due is not admitted and does not appear in the net admitted assets column of the statutory balance sheet. The liability side of the balance sheet shows the case reserve of 400 and surplus of 2450 minus 400, which equals 2050. The asset exhibit. To reconcile income statement surplus with balance sheet surplus, we adjust income statement surplus for transactions and statutory accounts that do not flow through the income statement. Exhibit 1, Analysis of Non-Admitted Assets and Related Items, page 13 of the annual statement, shows the change in non-admitted assets during the year, which is the needed adjustment to the income statement surplus. Why do we want the change in non-admitted assets instead of the non-admitted asset itself? And why does an increase in non-admitted assets lead to a decrease in surplus? Consider again the illustration above. Earned premium during the year is 1,000, but the 1,200 of premium receivable at year end is not admitted, since it is more than 900 days past due. The increase in non-admitted assets during the year, from 0 to 100, really means a decrease in the admitted portion of the assets. Do not think of this as a fixed admitted asset, to which is tacked on a non-admitted asset. Rather conceive of the total asset as a fixed amount, so an increase in the non-admitted portion is a decrease in the admitted portion. The earned premium on the income statement is an increase in total assets. If total assets increase during the statement year by 1,000 and non-admitted assets increase by 100, then admitted assets increase by only 900. The income statement shows revenues, which correspond to the increases in total assets. Subtracting the increase in non-admitted assets gives the increase in admitted assets. The increase in non-admitted assets is a direct charge to policyholders' surplus. The statutory balance sheet. The statutory balance sheet uses 4 columns to reconcile with the income statement. Column 1, total assets. Column 2, assets not admitted. Column 3, net admitted assets, columns 1 minus 2. And column 4, net admitted assets prior year. Agents' balances are in column 1. The portion more than 90 days past due is recorded in column 2, and the difference is the net admitted asset in column 3. The change in the non-admitted asset appears in Exhibit 1, Analysis of Non-Admitted Assets and Related Items. Column 1, Non-Admitted Assets at the end of the current year. Column 2, Non-Admitted Assets at the end of the previous year. Column 3, Change for year, increase or decrease, or column 2 minus column 1. A positive entry in column 3 means a decrease in non-admitted assets, and a negative entry in column 3 means an increase in non-admitted assets. Surplus adjustments. An increase in non-admitted assets, given fixed total assets, is a decrease in net admitted assets. The negative entry in column 3 of Exhibit 1 is carried to page 4 and reduces surplus. A decrease in non-admitted assets is an increase in net admitted assets. The positive figure in column 3 of Exhibit 1 increases surplus on page 4. The non-admitted assets in Exhibit 1 include only the assets on lines 10 through 17 and 19 through 21 of the balance sheet, plus certain other assets. 1. Bills receivable past due taken for premium. 2. Furniture and equipment. And 3. Loans on personal security. Exhibit 1 does not include the non-admitted portions of financial assets, lines 1 through 9 of the balance sheet, or the excess of book over market, or amortized, values. The change in the excess of book over market from one year to the next is the unrealized capital gain or loss. The net unrealized capital gains or losses are shown as a separate adjustment to surplus, page 4. Office furniture. We show several examples of entries peculiar to statutory accounting. Insurers have 2 statutory accounting options for non-admitted assets. Method 1. Write off the non-admitted asset as an expense in the income statement. Method 2. Use GAAP entries for the balance sheet and the income statement, but classify the asset as non-admitted with a direct charge to surplus. Suppose an insurer buys office furniture on December 31, 20X4, with a useful life of 10 years for $100,000. The insurer uses straight-line depreciation. The 20X4 GAAP entries are credit cash by $100,000, cash paid to purchase furniture, debit an office furniture asset by $100,000. Both entries are on the balance sheet, and there is no effect on GAAP equity. These are ledger entries. The purchase of the furniture is shown on the accountant's ledger. For statutory financial statements, the Method 1 accounting entries are credit cash by $100,000, cash paid to purchase furniture, debit general expenses, income statement by $100,000. The entries are on different financial statements, and statutory surplus declines by $100,000. The Method 2 accounting transactions are credit cash by $100,000, cash paid to purchase furniture, debit an office furniture asset by $100,000. Enter $100,000 in the non-admitted column for the office furniture asset. The non-admitted assets increase from 0 before the purchase of the furniture to $100,000 after the purchase of the furniture. The change in non-admitted assets of plus $100,000 is a direct charge to surplus. The year-end 20X5 GAAP non-ledger entries are credit the office furniture asset by $10,000 to reflect depreciation. Debit depreciation expense on the income statement by $10,000. For statutory accounting, if Method 1 is used for the initial purchase, There are no accounting transactions in subsequent years. The full $100,000 was an expense in 20X4. The Method 2 accounting transactions are: credit the office furniture asset by $10,000 to reflect depreciation. Debit depreciation expense by $10,000. The non-admitted office furniture declines from $100,000 to $90,000. The minus $10,000 change in non-admitted assets is a credit to surplus, offsetting the debit from the income statement. GAAP depreciates the office furniture by $10,000 each year to match revenue and expenses. Statutory Method 1 says that the office furniture has little or no realizable value. It cannot be used to pay claims, so its entire value is written off when it is purchased. Method 1 requires two sets of books, one for GAAP and one for statutory accounting. This complicates the accounting, and it may lead to errors. Method 2 uses GAAP books only, but it non-admits certain assets. The income statement entries are the same as for GAAP statements. Any changes needed are made by direct changes and credits to surplus. Accrued retrospective premiums. Accrued retrospective premiums are taken from the Underwriting and Investment Exhibit, Recapitulation of All Premiums, page 8, Part 2A, column 5, line 33, accrued retrospective premiums based on experience, and entered on page 2, line 10.3, column 1. The non-admitted portion, usually 10% of the unsecured portion, is entered in column 2, and the difference is entered in column 3.